Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
So welcome back to the summer series on the Australian Finance Podcast. So I'm Gemma Mitchell and I'm with Owen today. How are you, Owen?
I'm very good, Gemma. And what an introduction.
Oh, getting better and better.
Getting better and better.
Big shoes to fill from Kate.
Oh, maybe. But financial advisor, money coach, I think you've already filled those shoes pretty well. So we're going to be talking about shares and ETFs today.
Yes, excited to get into it especially because it's a great lead-in from from last week's about superannuation.
Yes, it is. You're going to have to slow me up. You're going to have to rein me in because I get a bit excited about this part of the summer series. So,
well, we're on the clock, so
we are on the clock.
You know,
we've got a counter here, everyone, and it's sitting on the table to make sure. Mostly, I am on time.
Staying, yeah. So I talk slower and you talk less.
Okay.
That's the goal.
Sounds good.
All right. Well, we're going to be jumping into what are shares and ETFs, why it's important, your main points on what we need to know about them, and then kind of a where to from here, whether you are getting into them or who to go to for help.
Yeah, sure. So we did originally have this as two separate episodes, shares and ETFs, which is how we've done it in the past. Let's start off with what they are and why maybe we've combined them. More people than ever are now using just ETFs to invest in the share market. So if this is your first time listening, we'll explain what ETFs are, so don't worry about that, and we'll explain what shares are. So what are shares? Shares are just part ownership in a business. A lot of people get really confused, and you see this all the time, Jim. Mm-hmm. They think that shares are like gambling, just because they go up and down and involve money. Mm-hmm. They think that it's totally random. And it can seem like that in the short term. But at the end of the day, shares are just part ownership of a business. Just like you might own your own bakery, you are the only shareholder, so there's one share for the whole bakery. The difference with the share market is that we're dealing with massive companies like McDonald's or Apple or Commonwealth Bank or something like this, where you're only a fractional shareholder. Even if you put in $10,000 or $1 million, you still wouldn't own even 1% of those companies. So you own a small share. Some people get confused just for this, the real new investors in the room. Some people get really confused and they think, well, Commonwealth Bank share price is, I don't know, hypothetically, $150, but ANZ Bank is $30. Does that make CBA a better share just because it's got a higher price? No. The key understanding is that if you got a pizza, like a large margarita, say, and it's $20 from the pizza shop, you cut it up 20 different ways, it's $1 a share. You cut it up 10 different ways, it's $2 a share. Same pizza, you just get a bigger slice. And so the idea that the number represents something in the share market is not really a thing. It's more how much are you investing. So we know that shares represent ownership of a company. So what are ETFs? About 30 years ago, at the time of recording, ETFs or exchange traded funds became a really big thing. And they kind of just came out of nowhere and people were like, whoa, you can do that? And let me explain what it is. Instead of picking which shares you want to buy, so say Commonwealth Bank, Tesla, Google, whatever, you get a basket. An easier way to think about this, I would say actually, is probably like a box of favorites. Instead of picking whether you, Gemma, like Turkish Delight, I don't think anyone likes Turkish Delight.
I actually do now, but it's only been in the last couple of years that I'm getting older.
Okay, well, there's one.
So save them for me.
Yeah. I often use that as an example, and when I do speeches or whatever, I pick on Turkish Delight, and there's like 2 or 3% of people in the room that kind of tilt their head and they're like, who is this guy? Yeah. I like those things. But say, for example, you went and you rocked up at a house party and, all you take is 20 Turkish Delights, you'd probably get a few odd faces being like, is she into Turkish Delights? No one else likes these things. But if you rock up with a box of favorites, hence the marketing, you got a bit of everything. So everyone's happy. Yes. It's the same with ETFs. Instead of trying to pick which shares you like to buy or which company or which bank or whether it's Apple or whether it's Microsoft, whether it's Tesla or whether it's Toyota, it doesn't really matter. What you can do with an ETF is just bundle them all up and put them together. And instead of putting $500 in CBA, you put $500 in Australian shares ETF and you get heaps of different companies.
Yes.
And
so it makes it a lot easier to diversify with a smaller amount of money as well, because if you had to go direct to all of those shares that are in the ETF potentially, you would have to put a set amount or like a minimum amount into each of them.
Yeah, because as we'll discover in a moment, in Australia, typically the minimum to invest, depending on the platform you use, could be $500.
Pretty common, yeah.
Others might be $100. And so when you're starting out, if you want diversification, quote unquote, you typically want quite a few shares, but you don't want to have to go and buy 50 of them because you're going to end up having a lot of costs because you have to, every time you buy, you pay something called brokerage. So it doesn't make a lot of sense. Instead, you buy one ETF and you go from there.
And that can take out the analysis paralysis of what do I actually buy?
Yeah. See, the thing is, in the last 10 years, we've gone from about 50 ETFs to nearly 400 at the time of recording. And so, in effect, what you have is now more analysis paralysis just based on the ETFs. But it's actually a good thing because now you've got choices across everything. So if we think of an ETF, if you're getting started investing, really, really good because you don't have to pick which stock. If you're further on in your journey, people are like, oh, it's kind of boring. But you can have your cake and eat it too, or you can have your box of favorites and eat your Turkish Delight as well. You can build what we call a core portfolio of just these ETFs that kind of just sit there and do their thing. That's what I'd spend a lot of my time doing. But then off to the side, you can still buy the individual shares. Like let's say, for example, you're like, okay, I know I should invest in the Australian share market, so I'll buy an ETF for that. I'll buy an ETF for European shares. You can do that too. And I'll buy an ETF that does, I don't know, property, right? Won't go into the detail of that, but you can do those three things. And then on the side, you're like, you know what? I think Tesla's going to be a really big thing in the future. I'm going to buy, $500 of that or $1,000 of that, depending on whatever your means are. And so this is what we call the core and the satellite approach. Really popular around Australia and around the world. And it's what I do. I have the core ETFs, the core of my portfolio that I just add to every month. Really simple. And then around the outside, individual shares.
Yeah, I think this is a really good strategy for people that want to get into like more speculative kind of things, like things that they're really excited in. It might be a friend's business or you got that hot tip at a barbecue and you want to follow it, but it's not actually derailing your path, your actual solid financial plan, how you're going to build your wealth. That's your core. You keep doing that slow and steady with what do they say?
Tried and tested.
Yes, methods. And then you can have a little bit of fun with other things, but you just don't want it to be the whole amount. So you might decide that that's 10% of your portfolio or whatever, that you are more likened to kind of gambling, I guess.
Yeah. And another thing you can do with the Gem is you can do something like where I do want to do more investing in individual companies or individual shares, and I want to do that more often in the future. However, I'm not prepared and I don't think I've done my quote unquote apprenticeship yet. I feel like I need to earn my stripes. And one of the ways you can do that is start with the ETFs. And then let's say, for example, you have $20,000. You could start with the ETFs of, I don't know, $19,000 and put $1,000 in a share and then keep saving. And then, in a few months, put a little bit more in another share. And in that way, you know that these ETF things are pretty reliable. But on the other side, you can still learn about shares. So I think it's actually a great way to learn how to become a better investor.
And build your confidence and see how you feel and how you emotionally react in different market cycles with a little bit of protection of having that big diversifier.
Because for years, people have told us that when you invest in the share market, it's like gambling. You do have to, quote unquote, trade stocks, which I think is very risky. I prefer the term investing in stocks because I think that's what you should do. And I don't know if this joke's going to fall on deaf ears, Jem, but Warren Buffett has this famous joke where he says, you can't get 9 women pregnant and have a baby in 1 month. Meaning you can't speed up the process of earning returns from the stock market. And the idea here is that if you try and trade stocks, I find that you're trying to speed up something that cannot be sped up necessarily. But what you can do is you can buy companies and shares that you're interested in. And maybe you do find a really interesting company, but just don't bet the house on it. A reason why people think the share market is like gambling is because they see negative results. And the data tells us that 1 in 5 years is negative. So if we invested for the next 5 years up until, say, beyond 2030, one of those years is going to be negative. And chances are it might even be 2. Or that one bad year could be really bad. And people take that one bad experience and think that that's indicative of everything. And it's easy, it's just human nature. But over the long term, once you understand that some years are bad and some years are good and the good outweighs the bad, you get to understand why all of the wealthiest people in the world invest in businesses, aka shares.
And the same thing's happening with property, but the difference is that we don't get a daily report on what property prices are doing. Like, I know it's all through the news, but people are like bombarded with negative like returns on shares, but they don't see that volatility in property. So it's harder for people to connect to it as a safe asset. But I find that once people kind of understand how shares work, like how you can make money from them, and how that is very similar to property, like in the concept of it, then it's a little bit easier for them to wrap their head around. So, for example, like most people know that an investment property can make you money 2 ways, one of 2 ways. It could grow in value and it could potentially give you rental income or both. A share is pretty much exactly the same. It could be producing you income if it's an Australian share with dividends, which is just like rent, or it could be growing in value, which is your capital growth like a property grows. But really it's very, very similar. It's just one is an asset that we see and the other is, like us having a slice of a company that feels pretty far away from us.
It does, yeah. And like you said, that daily update is so important because you can log in instantly, like right now, and I could check something, which is why I don't have the apps on my phone. I do all of my share investing via a computer, which I know seems so old school.
It's very millennial. Big decisions have to be done on the computer. But I've worked with a lot of retirees. So when you're working and you're accumulating, you're saving and you're investing, when you get to retirement, you're then using that money. And I've seen the mindset, like the behaviors of it constantly checking the share market, what your super fund's doing and being really worried about the fluctuations. And so in instances like that, I've told them you have to get rid of that app or you're not allowed to check it. You have to wait once a year to your statement, or if you want to check your balance, you've got to call the fund just to remove that constant access, which if you're checking it too often, it is going to concern you because there is volatility on it. But there's that on property where you just don't get it.
So we've been working with Perla, who's a sponsor of the show for many years. And the reason why I decided that we should work with them way back in the day, Gem, is because when you open the app or the computer and you log into Perla, when you see a share, it defaults to a 10-year share price.
Oh, that's good.
So this doesn't happen for anyone that's new to this. That doesn't happen because the app and the website wants you to trade. So they give you daily updates, so it makes you scared or makes you impulsive. So you buy and sell because every time you buy and sell, they earn a fee. Whereas when an app comes along and goes, well, here's a 10-year share price chart, nothing to worry about today. Even if it's a negative day, you wouldn't even know because it's like a little blip.
It's a blip, yeah. And one of my favorite sayings, I think I say this every episode and I've got a different saying, but one of them is, if in doubt, zoom out. And that's exactly it, because what feels like a massive, like devastating blow in the market today is generally like a pretty small blip when the further that you zoom out on the charts.
I find that during COVID, when everyone was really scared of the share market or even property prices, some so-called experts came out and said property prices are falling at 20% a year. Property prices are falling at 30% a year. Basically, they were just getting the last week's data and then multiplying it by 52. But they were getting these really scary numbers out. And I thought, well, let's just stretch that chart out. Let's get the numbers over 50 years, 100 years. And the longer you do that, the more you realize that, there's some ups and downs. But over time, things are pretty positive. There've only been a few years, Gem, when there were 2 negative years in a row. There were the 70s in the Depression era, really bad years for investors in the share market, which is for obvious reasons. But over 123 years until the end of 2022, so 2020 started 2023, over 123 years, you can go and Google this. You can Google Credit Suisse long-term stock returns, I think it's called. They've showed that the Australian share market was the number one in the world over that entire period. Now, if you go the last 30 years, the United States share market wins. On a purely percentage basis, and we'll put a link of this to this in the show notes because this changes people's lives. On the Vanguard website, you can go back to 1970 and you compare it to today's prices, so say towards the end of 2024, to see that Australian shares returned 9.7%, US shares 12%. So this is the last, 70 years? Oh, no, sorry, 54 years. Cash returned 7.3%. But if we bring this chart forward, I'm going to do this myself, to 1990. It's a great year because that's the year that around about I was born, not to give too much away. Never asked a podcaster his age, they say. But since then, till now, Australian shares 9%, US shares 11%, property 8.7%. So property's in third spot. People forget that the share market has actually outperformed property in percentage terms.
Yes. And the thing I love about shares, whether it's ETFs or whatever, you don't get a call saying, hey, our bathroom broke or the water heater, cough up money. There are so many expenses that go with property that, you don't have to worry about when you're a share investor. Yeah.
Some of our most popular content of all time is property versus shares. Do both.
Yes, I know. And that's the exact thing. Like, you need to be diversifying. So one of my things that I get really worried about is when people are very pro property. So they have their family home and investment property, and then they look at changing their super into an investment property. I'm like, now all your assets are in property, but it's actually great to have all of this diversity. And maybe you are picking some of the shares, and maybe then you're leaving some to the experts or to an ETF or something. But diversification across different assets as well as different kind of systems is really important.
It is. And to see the power of the share market or all types of investing, you said in a previous episode that it's about just buying assets while you're working, because then when in your retirement, you rely on those assets for income. The best thing you can do, anyone listening to this, if you haven't experienced this before, it changed my life, was go and find a compound interest calculator. We can link to one in the show notes. And what you can do is you can put in how much you can save and then the percentage you might earn from that investment, and it will calculate what your future money will be. But the really powerful thing that people don't realize until they do this is just how powerful that small amount of saving can be. And what becomes the most powerful thing is not how much you put away. It's not even really how long you do it for. It's actually the percentage return that you get. Like, after you've got a little bit of money in there, the difference in return. And so people are like, well, it's safe in cash. I'll put my money in with ING Bank or Macquarie or CBA or whatever you use. I'll put it there and I'll get my X percent. The share market, the reason that the share market does well and does better than that over time is because most people aren't willing to take the risk. So when I say most people, a lot of people aren't willing to take the risk. And so by having some of your money, just some of it even, at risk, you earn a better return. And over the long term, that's what pays off. And that sees that compound interest calculator tick up in a big way towards the end.
And you can mitigate that risk so much by diversifying and looking at big, solid companies. For example, even if CBA share price was down, the value of it, you'd still likely be getting a dividend payment. So there's different ways that you can mitigate that risk. And lots of people think that the bank is safe, but there's a risk there as well. And it's that your money's not keeping up with inflation.
Exactly.
So it's just about making sure that, well, what are your goals? And does it make sense to have it in cash, even if it's not a great return, because that serves a purpose? And what's your long term? Does that make sense to have in shares? But I think you need to be considering all of these and how they work together. You definitely can't rule it out. You can't afford not to take some risk.
Yeah, I think that's the difference. In the past, people would just say work and put money in the bank or pay off their mortgage. And there's this huge consensus of people that are now emerging thanks to things like podcasts, social media, Reddit, all these types of places that have finally shined a light on what is investing and what isn't investing. And what is investing is simple long-term investments. Sure, you can buy individual shares like Warren Buffett does, or you could buy an ETF like from Vanguard or sponsor of the show, Betashares or iShares or whoever, or it doesn't really matter. And that takes away a lot of the guesswork. And the good thing about using ETFs for your core portfolio is that 1, they're pretty straightforward. 2, they're pretty low cost. 3, they're fully transparent. You can actually go to the website and see what's inside them. 4, you get a tax statement at the end of the year. Like they send you the tax statement. If you put your tax file number in, it should pre-fill. And so you get all this stuff that's kind of done for you. And if you're getting into this and you're like, oh, I'd like some examples, we do have an ETF mini series that we'll link to, which takes you through like all of the basics of an ETF, as well as how to pick one. We research some examples, and we've got a free ETF course. It's our most popular course of all time. Surprise, surprise, ETFs are super popular. And we've also got more advanced courses for share investing and all that sort of stuff. Some of them are free. There's only one that's paid. I'll also put in the show notes and in the document that we've got for you for the summer series, a few resources, including to some tools that I use, even as a professional investor these days. You can access them. Tools for tax reporting. There's so many different things in there, how to get, different stock research and that sort of stuff. I'll also put a link to some community data from Perla, who's a sponsor of the show, full disclosure, that shows that on average, people deposit around, let's say $2,000 to $3,000 every 3 weeks, and 90% of that on their platform is getting invested in ETFs, which is if you think about the future of what people are doing with their investments, it's probably majority, as you said, Gem, ETFs and then some shares around the outside. Like do your property and all that sort of stuff as well. But for your actual money, that's probably where a lot of people are doing it. In our community, it tends to be about 70 to 80%. 70 to 80% are in like ETFs or similar types of investments. And then there's 30% in direct shares. But hopefully this illustrates the point. Like you said, shares can be like property in that they grow over time. They pay an income, especially good in retirement because you don't have to deal with tenants. You don't have to deal with one big asset. You can diversify. It's really low cost to buy shares in ETFs these days. In some instances, virtually free. You can see all of what you own. Final thing is, if you need to choose a broker, you need to use a broker to buy shares and ETFs in Australia, in every part of the world. We'll put a link in the show notes to some resources on how to choose a broker. But typically the investment size starts at $50 up to $500 for a minimum investment amount. Gem, I think I'll end or put a ribbon on this with one final quote, which comes from the Tony Robbins book. I don't often quote Tony Robbins, but there's a book that he wrote years ago called Unshakable, which is a really interesting kind of short book. And he has this phrase about investing. He says, turn yourself from a consumer of the economy to an owner of the economy. Benefit from, every time you go to Macca's and you see large chips getting made, if you own shares in Macca's, you'll feel a sense of pride because you'll know that some tiny little fraction of that chip is going into your pocket, tiny little fraction. Or if you go to buy a new Apple device and you're like, gosh, that's expensive. Yeah. There's another party brand that's like, good on you, Apple.
Or your weekly like Coles shop or whatever. You're just like, this hurts a little less because I'm a shareholder.
Yes, exactly.
But I think it's also real, like there's a saying, I can't remember who said it, but if you can buy shoes online, you can buy shares online. So most of us are very comfortable with online shopping. Buying shares is literally as easy as online shopping.
I love that.
Yes, you have to pick the platform, so the shop that you're going to buy from. You have to pick what you're going to buy, but it's add to cart and click.
Done. We've got free courses on this. They're really straightforward. You can do quizzes and test your knowledge as you go. A good way to get started. I'll also include in the show notes links to some popular companies' annual reports. So this is how you can understand what the company actually does, like Commonwealth Bank, Apple, Tesla, even Australian companies. I'll pop some links in the show notes. And all you've got to do is click that link, have a read through the company to find out how the products and services all around you are made and why it pays to invest in these types of companies. If you want to learn more, you can always just jump on our mailing list. That's free too. And every week I send you an email. A lot of it's to do with investing. Gem, we've covered a lot of ground. We tried to squeeze ETFs and shares into one. There's heaps of resources available across the Rask network for you. If you're interested, jump into the show notes, jump into the YouTube description. and you'll find a lot more. With that said, this is heaps of fun. We'll be back in the next episode. We're talking tax.
Tax, yes.
Tax.
Very important.
What's important? I don't know if it's as fun as investing, but it is.
Definitely not.
Definitely not, but you can make money
very,
from
very
it.
Important. So. Yeah, and I think the biggest thing is tax is not a bad thing. Tax means you earn money, so it's a good thing.
That is good.
But you do need to know all about it so that you don't pay too much.
Yeah, that's good. That's a good point. It's all about perspective.
Yep.
Well, Gemma, thanks for joining me.
See you next time.
Thanks for listening to this episode of the Australian Finance Podcast. This series is sponsored by Betashares, one of the leading providers of ETFs here in Australia, managing tens of billions of dollars for over 1 million investors. In this next couple of minutes, I'm going to give you a quick overview of one of the super popular Betashares ETFs, which is known by its ticker symbol A200, otherwise known as the Betashares Australia 200 ETF. What does it do? The A200 ETF invests directly into a basket of 200 Australian shares. This ETF tracks the Selective Australia 200 Index, which is an index of the largest companies here in Australia. Think Commonwealth Bank, Woolworths, Telstra, CSL, and these types of companies. With one investment into A200, you get super low cost exposure to a diversified portfolio that includes banks, resources companies, supermarkets, telecommunications, technology, and so much more. This ETF, being so low cost and diversified from a reputable ETF provider, is often considered one of the core building blocks of a portfolio. When a lot of investors, whether financial advisors or individual investors, choose to build an ETF portfolio, they typically start with the core of someone's portfolio, and in there, Australian shares tend to be one of those big building blocks. So you can use this ETF in the core of a portfolio, or for whatever reason you might want to have it in the satellite, maybe as a starting position, you can do that too. However, I primarily see this ETF being used in that core because it is so low cost, it's diversified, provides dividends, provides franking credits to investors, and so on. If you invest in the A200 ETF, or if this is your first ETF that you've ever invested in, you should know that at the end of the financial year, that's after June 30th each year, you will get what they call a tax statement. And the tax statement is something that you can hand to your accountant or use to pre-fill or fill in your ATO account when you do your tax return. The A200 ETF is one of the most popular in Australia because it's low cost, it's diversified, and it's run by one of the most reputable ETF providers. Now, if you're confused, I would highly encourage you to check out the Betashares website, in particular betashares.com.au. Head to the page that shows the A200 ETF, and down the bottom, you will find the Product Disclosure Statement, or PDS, and another thing called the TMD, or Target Market Determination. Some people think that these are boring documents, but these are really important. The PDS tells you everything about A200 that you need to know, while the TMD tells you if it may be suitable for you. That's a new document that is really helpful if you're just getting started, because it will tell you what type of investor was this ETF designed for, and you can use that to assess if it's right for you. If you're still confused, or if you just want some support, I would highly encourage you to get advice from a licensed and trusted financial planner. I think financial planners are amazing, and they can help you build an ETF portfolio from scratch. Thanks for watching this episode of the Australian Finance Podcast. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.